Hi, this is Randy Finney with Right Side of the Chart, and this is a market recap for Wednesday, July 20th, 2016. Not a whole lot to cover in the markets today, so I'll touch on the equity markets and then take a look at gold because now we do have some pretty interesting developments. And as I mentioned in the trading room this morning, I had to run out to an appointment earlier today, but I mentioned for the first time in quite some time I'm considering adding a nugget or a GDX short as an official trade idea. When I got back from the appointment, it was just down a little much. I didn't look like a very objective entry, although I think we're setting up for a pretty decent move. But we'll get to that at the end here. Let's just touch on the broad markets. This chart was put up in static form, I believe, yesterday on the site. This is the S&P 500 daily chart showing the third consecutive divergent high. And, we had a decent day today in the S&P up 0.43%. The NASDAQ was the stronger performer with Microsoft, beating earnings. And but again, bigger picture, today's price action has done absolutely nothing. And even in the near term, there's really not anything changed. If there's time, I'll just zoom down to the 60-minute charts to wrap up. So there's the S&P 500. Take a look at the NASDAQ 100, which, as I mentioned, was a stronger performer today. The NASDAQ's giving me a little pause here. It's taken out that New Year's gap. That was always my line in the sand. Somebody asked me in a private message today. Although they weren't official trade ideas, I had a QQQ short on for a while, and I took off a third of that before the close today because that was my plan all along. And I'll continue to scale out. It has no business being up here much higher. We've taken out that New Year's gap, which was a pretty big level. You can continue to draw downtrends off the highs on a lot of these indices. And the most important thing is we haven't taken out the highs yet, and we still have this divergent high. And there is a potential, as I said, for that divergence to be burned through, meaning if we take out the previous reaction high in the MACD and the RSI, then the divergence is then negated or burned through. But as of now, it still exists, so something to keep an eye on. And let's look at the small cap stocks real quick. Russell 2000. Let's see if I have a board mocked up. Here we go. Russell 2000, this is that key resistance zone. These two lines right here, you have this reaction high and quite a few reactions back here. And we're really just struggling right on that line back around that previous reaction high from when is that? Late November 2015. And just like everything else, you have three consecutive divergent highs. We did have a divergent high at this point back here. We broke this trend line. We had that sharp snapback rally. And this really, in the more near term, you can look at this very steep uptrend line, which has just recently been broken, but prices really haven't done much yet. They're holding up, so we haven't seen any follow through on the breakdown. Again, those were highlighted on the 60-minute chart. Okay, so bigger picture, U.S., all the broad markets, there's really nothing technically significant. I did mention that the NASDAQ taking out that New Year's gap, which to me was a pretty key level, especially back then at the time. However, still below everything other than the S&P 500. All the indexes that are diversified, meaning 100 or more stocks, not 30 like the Dow, those are all still well below, or at least below their 2015 highs, and you have these divergent highs. So I still think the intermediate near term to, more importantly, the intermediate term bias is still negative with those divergences, because as I mentioned, they do more often than not play out. Now, the big thing lately is gold. Let's see if I get a cleaner board here. Yeah, this will show us a good story without a lot of noise on here. The divergent high. This is GLD, the ETF, but if you look at this chart of spot gold, you'll see the same thing. These divergences are glaring. These are big divergences. They are confirmed divergences, meaning we've had a bearish crossover here. This has all been covered going back a few weeks. I pointed out those potential divergences before they happened, and we're seeing some nice downside. Now there is some support here. These lines here are some key levels that I mentioned. So roughly 125.10, 120.05, or call it the 120 area, and then the 115 area. And I think very likely there's a good shot. I think that 120 has a really good shot of being hit. And so what I've done here is you have this uptrend line. You can see numerous reactions here, 1, 2, 3, or 4, another reaction there. So I think that'll come into play. And each level that you see on these charts below current prices is a support level. So you have this near-term uptrend line right here, which we just really closed on today. So this is really one wedge type pattern, if you will, the white lines here. And that's one reason I didn't add the Nugget or GDX as an official short. And for those of you new to the site, if I'm looking for, in this case, I'm looking for what will likely be a multi-month swing trade, at the very least a multi-week swing trade. And it's preferable, in my opinion, to short the 3-time long ETF Nugget, because if we get in a sideways trading range like XOP, that one's still active, still not stopped out. And my preferred trading proxy was Gush, and you can see that Gush, well, I'm not going to do it here. I put up the stats in the trading room recently. You can do it yourself. Go back to a 60-minute chart. We shorted somewhere back here, and the XOP trade is, although it already hit the first target real early, and I was still holding out for this additional target. What happened is we've been stuck in just a vicious sideways trading range where Gush, or XOP, the oil and gas exploration ETF, has gone virtually nowhere. We've had that trading range going back and forth, and here we'll do this. This will show you. So if I just take the highest point, which I grabbed there back in that looks like the end of April, and go till today's close. If you look at the box, the red numbers on the lower end of the box there, it says down 7%. That's XOP. Again, that is off the highs right here back in April 28th. And we shorted sometime just after that. So that it's still positive there by 7%. Now one might think, okay, if you short the 3-time long ETF, you should be up 21%. Well, let's grab that same reaction high. Let's grab today's close, and there it is. You can see that you actually have a gain, or Gush is down over 26%. So versus that 7%, or 3 times 7% would be 21%. So that extra 5+%, which is a pretty good number in that amount of time, is simply due to the decay that you have. And decay works great. It works best actually in these back and forth ranges where you have up and down closes. You can take a 3-time ETF, and you can do this with Nugget, for example. If you're trading Nugget and you were long from here to here, you did fine because there was very little give back. It's those give back. It's these sideways back and forth trading ranges like this that really work against those leveraged ETFs. And that's why if and when I add GDX as an official trade idea, you're probably not going to see dust unless I can make the case for a very swift, mostly unidirectional move. In other words, if GDX were to just continue down sharply, you do okay. You actually can outperform. You can do better than 3 times GDX if you're long dust, which is the 3 times short, if GDX just drops every day. That's how the math works. And that's, again, if you're confused on what I'm talking about, just visit the frequently asked questions page. It's on the top menu of the site under FAQ. Click on that, and there's some ETF questions, a subsection for ETF questions, and I explain decay and how that works. So again, best to avoid going long, especially volatile sectors, the 3-time ETFs. And the most volatile sectors that I know of that have 3-time ETFs are the biotechs and the gold mining stocks. So I'm more than glad to and enjoy shorting those ETFs. Whether I want to short the short version to go long or short the long version to go short. All right, enough on that, and let's just get back to the charts here. So here's GDX. GDX, I've covered this quite a bit in recent weeks, not a lot lately. You had this divergent high. We had a nice correction, and we just missed making a second divergent high. But I made the case. I did a video just a couple weeks back. You'll just have to go to the front page, the post by ticker symbol, pull down the ticker for GDX, and go back, and there's a video in there where I covered GDX and most of the components, which have hit or at or very close to very significant levels on the long-term charts. When I say long-term, here's a weekly chart, a 10-year weekly chart, and this orange line here around 31.25 roughly on GDX, a very significant level with a big gap, numerous price reactions, and more importantly, when I did the video of the individual components, you drill down, you can see a lot of those hitting, and we can just rifle through them here. I have my watch list. There's ABX rolling off that. Again, these were all covered in the video. That very, very solid resistance level and significant gap right there. Newmont coming up. There's a wall of resistance right there. GG, again, go down the line. There were a few that weren't, but most were. You can see these reaction highs. So I think the time is right for a swing trade. I think the miners, as I stated yesterday in the trading room, at the very best, will face significant headwinds going forward for the next couple weeks or months. Let's look at the Huey for a second. The Huey, before GDX even existed, back when I got in the business, there was the Huey. Huey's still around. It's a gold bug index. It doesn't have the exact same weightings with the same components, but it is an index of gold mining stocks. So what's nice is you can go back on a monthly chart. You can go back a lot longer because you have longer trading history. So let's just start there. This is a monthly chart going back to the mid 90s, and this was a big, very strong secular bull market in the gold mining stocks. It's terminated in this sort of wedge, a large rising wedge type pattern, confirmed with divergences. Same kind of pattern you might trade on a daily or a 15-minute chart for that matter. And there it was. We broke down, but what stands out to me, this is a support zone. I'm sorry, a resistance zone. These two lines, you can see numerous reactions here once we broke below that level. Where we failed before. There were reactions from above here, reactions from above right here, reactions from below back here. So this is a pretty significant resistance level. And now what stands out to me is the move that we've had in the Huey. This is pretty much an unprecedented run without any give back. When I say give back, yes, there was a red candle in there, but look, this is just really one continuous move up. So this is, what is that? Each candlestick is a month. 1, 2, 3, 4, 5, 6, 7 months. So if we just sort of play around, this is a log scale. So if I make this line here, it'll match up here. That's the difference of using a log versus an arithmetic or a linear scaling, is that these lines won't match up because the price scaling is different, but on a log scale they do. So really what I'm looking at here is, you can see it, at least going back for decades here, the miners have never had such a run without a pullback. And here's what I'm talking about. Even if we get this, let me grab a highlighting tool here. Even if we just get this, wrong tool, excuse me. All right, let's see if that works. Okay, even if we get that, there's several months. That's 1, 2, 3, 4, 5, 6, 7, 8, 9. Over 9 months of sideways action, and a decent pullback from the top. I can measure it if I want. I can guarantee it's probably double digits. There's some more sideways action. So this is what I'm looking at. This is my expectation from right here. I don't think we're going to see another. What is this in percentage terms off the bottom? Let's grab it and measure it. 175%. It's unprecedented. Is it possible? Yes. But for all the reasons that I mentioned in the previous videos, I don't think it's going to happen. Again, you can pick any point back here in time. We haven't had such a run of that magnitude without a decent pullback. And, some of these have come close, but this one takes the cake so far. And I'm talking in such a short period of time. Here was a nice strong run, but it was a more gradual, healthy, normalized, rally. There was, of course, a sharp snap back off the lows as that came after the 2008 meltdown when everything got sold. Beyond a lot of things beyond where they should have been. Valuations were really cheap and back there at the lows. So that's my thoughts on the miners. Let's get back to GDX. Just look at those targets again. Go back to a daily chart. These are each support levels. I don't have official price targets yet, but these are support levels along the way. And it will all have to do with this, the shiny metal. the miners are going to follow gold eventually, and there's that divergent high. Those are the targets I'm looking at. At the very least, I think we work our way down to that 120 area, and if we grind around and I'm short nugget, all the better. Some brokers I understand don't have a lot of availability. Interactive brokers, I've rarely ever had a problem finding shares of Nugget or a lot of these hard to borrow. They call them hard to borrow shares. They're hard to borrow at a lot of other brokers, but Interactive Brokers, by far for years, has had the best availability of both ETFs and hard to borrow stocks. So that's what I'm looking at. And again, I will try to hone down an entry. You can see there's some support there on, this is an old 60-minute chart I haven't updated, but there's really support right here about where GDX closed today, and that's why I didn't initiate the short position, but I'm keeping an eye out for it. And my preferred strategy, and what I'll probably recommend as for the official trade, would be a scale-in process. By scaling in, that means don't take an all or none position or full size position. Break it down maybe into, you pick a round number, whether you're shorting 10,000 or 100,000 or more or less. Let's say it's $10,000 and you short 2,500 now or at the next objective entry. You wait a few days, a couple of weeks for your another objective entry, or you just do it on a time interval. Maybe you wait another 3 or 4 days, short another lot, and then at the end of, let's say, a week or so, you're fully invested. And that what that does, it helps you getting in on the wrong days. In other words, today was 5.66% down in GDX, which correlated to a drop of 17.51% Nugget. Let's just say we snap back tomorrow and we come back up to this resistance area here, right around there. Very real possibility. And that would be a very objective add-on area. And it would also be very painful if you had taken a full position today, because you'd be, down 22% on your first day, which leads me on my final comments. I've said this, if I said it once, I'll say it 1,000 times. When trading the miners, and especially when trading the leveraged ETFs, you have to do two things. You have to adjust your position size first and foremost for the leverage in any ETF. So if you're going to short Nugget in lieu of GDX for a move down, right away you reduce that by about 1/3 your normal position size. Then you have the fact that the miners are one of the most volatile sectors out there. Daily swings of 5% in the sector, not even individual stocks in the sector alone are the norm. Therefore, you need to reduce your position by, even if you're trading GDX alone, depends on your risk tolerance and whatnot, but I'd say anywhere from 50% at least. So if you normally swing position of $10,000 and you short GDX, you should short 5,000. You're still going to make the same percent total dollar gains if the move is right, because a swing trade in GDX, you're not looking for 1-2%. You're looking for 10-20% or more. And like I said, when you add in that leverage, cuts both ways. I think most of you know that. I've had a lot of comments, and I think we've all experienced being on the, both the right and the wrong side of these trades with the miners in the last year or so. All right, this has been Randy Finney with the right side of the chart, and as I said, I will keep an eye out for an objective entry on these, and keep you updated on the markets. Have a great day.